All right, dude. How you doing?
Good. How you doing?
Good, man. Good to see you again. Good to get you back on the pod. Excited to hear about how Luxor is doing, and also to talk about your Star Trek badge.
That is not Star Trek. That's the old Luxor logo, but we'll take it.
You don't press that and beam up.
No, apparently not.
Man, dude. There's a lot to get into.
Okay. You tell me where you want to start, and I'll go there.
I mean, everything's kind of fucked at the moment.
Yeah.
But I want to be positive, and we should get there and talk about the positives. Harry Suddock would say to us, everything is good for Bitcoin.
Okay.
So it'll be interesting to work through how the events of the last week, 2 weeks.
What are you talking about? I mean, I'm surprised that I don't know what we're going to talk about, given there hasn't really been anything going on the last week. So I'm worried about what we're going to talk about for 2 hours here.
Well, it's interesting. And this is the last 2 weeks. We haven't had a football match. And you're obviously now a soccer fan.
Well, no, the pound is greater than the dollar. So we're back to football.
Okay.
It's no longer soccer. We're back to football, but we'll see.
You're a football fan now. We haven't had a game on this week, so it's been pretty quiet. But a few things have happened in the crypto/Bitcoin industry. I was originally wanted to talk to you about mining.
We can talk about mining. I kind of know more about mining than other things, but obviously we are, exposed to this as much as anybody. Where do you want to start?
Well, let's start with mining because miners have been under a lot of pressure. Some huge companies are under a lot of pressure.
Okay.
Some appear to be folding or in deep distress. And I'm kind of wondering how we got here, but I've got multiple. There's such a changing narrative. I saw a really good tweet this morning from Hodler where he said one of the reasons the Bitcoin price is suppressed is that people have been buying fake Bitcoin.
Okay.
In that, if I think what he's trying to say is that if people are trading on FTX and buying Bitcoin, and it turns out they've got Bitcoin liabilities of 1.4 billion. But they hold in 1.4 Bitcoin.
They own effectively zero Bitcoin.
Yeah, does that mean they've basically been spot selling air, and therefore there's been that whatever the buying pressure or selling pressure is. We could work the other way on selling as well. But have we not been getting a true Bitcoin price? Has everything that's happened with Luna, FTX suppressed the price so much that actually this has brought more pressure on mining that would have existed? If none of this bullshit had happened, what would happen to the price? But we can come back to that. Let's just talk about what's been happening with mining, and let's for anyone listening who doesn't understand mining, who hasn't spent too much time, let's talk a little bit about the growth. You explained the growth of mining over the last since the last cycle. We've got large public companies now.
Okay, so the last time we chatted, almost exactly a year ago, it was October 25th. We were in potentially the highest margin environment that had existed for a long time. We had 42-cent hash price, which is, we've actually moved to using petahash because it's down so much. It's actually about 0.055 cents now. So we use petahash. So it would have been $420 per petahash per second per day.
All right, I'm going to pause you there.
Okay.
I think explain the pricing of hash rate.
Okay.
And the reason I ask for that is I'm a miner. And I never look at that. What I look at is how much Bitcoin have I mined? What's the value, and what did it cost me to mine that much?
Right. Yeah. So a mining machine produces this compute power called hash rate. We measure it in hashes per second. Generally, around the time we were talking last time, 1 terahash per second per day would have produced around 42 cents, and today it produces about 5.5 cents. And the prototypical miner right now is called an S19J Pro. We just call them J Pros. The J Pro produces 100 terahash, and so today it'll be producing about $5.5 a day. This time last year, it would have been producing $42 worth of Bitcoin per day. There's the parameters that go into that calculation are actually very simple. It's Bitcoin price on the day. It's the the Coinbase reward, the transaction fee, all that stuff multiplied together, divided by the network difficulty. So at this time last year, we had actually just gone through the China ban, which we were just started to recover from. So in May of 2021, the about half of the hash rate, or even a little bit more of the hash rate, came off the network, which caused difficulty to go down. Hash price shot through the roof because Bitcoin price was rocketing as well at that time. And so we went into this, what I actually used the term golden age of mining. And I think I even said, like, this level of margin is not going to exist for long, because if you go into any industry and find you have 80 to 90% margins, they're going to be pouring money in. They're going to be pouring money into that. And one of the things I want to talk about on this pod is how this is reminiscent of energy cycles. And we're going to start. We are actually seeing the coincidence of an energy cycle, which is generally not doesn't correspond with Bitcoin. They have their own cycle. Bitcoin mining, they have their own cycle, and we're starting to see this coincidence of those two events right now producing the lowest margin environment that we've ever been in for Bitcoin mining.
All right, so Danny's pulled up the network data chart showing.
So this is
hash price?
Hash price, yeah. So this is hash price over the last year. And so we were talking towards the left end of that chart. You can see we changed it to petahash per second per day now rather than terahash, just because it's it's a little bit more intuitive. Actually, we switched to petahash per second per day because it actually coincides nicely with the it's the same order of magnitude as a barrel of oil. So a barrel of oil I think is about between $80 and $90 today. I didn't look it up before, but now the petahash is about $55.
Okay, so it was about $375 per
Petahash, which is around 10 machines.
And that's okay. And so now it's at about, but per machine it's about $5. $5.50
for that particular machine. The machines have come a long way. They're like the latest model from Bitmain is an S19 XP Hydro, and that thing does 257 terahash per second.
Hold on, was that a 2.5x?
2.5x, but it also uses 5,200 watts of power. So it's actually it's not extremely more efficient. It's maybe about 30% more efficient than a J Pro, but it's just a massive form factor and consumes a ton of energy.
But if a miner's making about $5.50 a day,
yep.
What I want to know is, well, based on 2 cents per kilowatt hour, what will its cost be? A daily cost on that?
3 times 24. I don't know. I can't do the math in my head.
Is it profitable?
It's going to be at 2 cents. Yeah, anything's profitable. I think even an S9 is going to be profitable at that rate.
Okay. So it's still profitable for most companies.
But nobody's paying 2 cents.
Right. So what are people paying?
So
because I always thought that was like the target. The 2 cents was the target.
That was the target in 2020.
But we've had an energy.
So we are going into an energy cycle. So let's back up a little bit. So in 2010, back when oil was crazy, oil was $150 to $200 a barrel on any given day. A high margin environment, investment was pouring into petroleum, drilling new wells, fracking, offshore, all of the ways that you can produce oil. They were funneling money into that ecosystem. Now, over the course of a couple of years, they overbuilt, caused the amount of production to skyrocket and crush the price. And then during that time, we were seeing oil companies starting to, in 2014, sort of when their cycle ended, we were seeing, oil companies going bankrupt. The ones that had high operating costs and low margins were going out of business, getting acquired. Those assets were effectively being fire sold to either private equity or something. Coincides similar with what's happening in Bitcoin mining today, but it took, around 6 or 7 years for the washout to occur. And now we're starting to see that influx in investment. Demand is up for petroleum products. And so we're starting to see more and more investment into that space, as well as higher margins because price of oil is going up and, demand is also going up.
So what is the kind of break-even price?
For a miner today?
Yeah.
So it's going to be somewhere around 8 cents.
Okay.
Probably. But no, it's very difficult to even get 8 cents today. So I would say that the best miners that are signing new hosting contracts right now are probably getting close to 6.5. Like that seems to be right now the floor, at least in the US, most developed countries. There are places you can go where the economics are significantly different. I call them OPEC plus. They call them OPEC plus countries. So places like Russia, Kazakhstan, they have probably the lowest cost of energy right now, but American businesses aren't able to operate there. So you can't send your miners to Russia to get, 2 cent power or whatever they have there, because they're, obviously what's going on over there is they're sanctioned and things like that. So right now, I would say the clearing price for hosting that is available to North American miners is around 6 to 6.5 cents. The closer to 6 cents you get, there are other types of hosting agreements that come into place, things like profit shares, or you're potentially putting your machines in relatively riskier locations. Texas, the odds of a guerrilla army coming and stealing all of your machines, while not zero, very, very low. Places in, say Venezuela, where you could get cheaper power, that becomes a little bit more risky. So you're going to start to move up that risk curve the closer you get to 6 cents, 6.5 cents.
Right.
Your average pleb miner that's doing 10 machines, I would bet they're looking at around 8 to 8.5 cents right now. So a J Pro probably not profitable for somebody in that tier. And so we're really seeing a consolidation of mining into these mega miners that are doing grid scale type mining.
Right. Okay. So let's talk about what happened over this cycle, because like we say, we have these huge miners now, these huge public companies that have grown. They've grown so quickly. What happened there? Why did we see that? Was it just by virtue of the fact that it was so profitable?
Yeah. So given that margins were so high, it made a ton of sense to do anything you could to get new machines and get them online. That was, the Marathon this time last year, they were raising hundreds of millions of dollars, making, billions of dollars actually, and investing hundreds of millions of dollars into mining machines. And the way they were able to get access to that capital was due to the profitability of mining. The margin was so thick that you could effectively run a mining machine anywhere. You could plug it in the kitchen over there, and it would probably produce, it'd produce $42 a day, and it would cost you maybe $10 to run.
And heat up your kitchen.
And your kitchen would be, 100 degrees. But now that same machine going to produce a little bit less Bitcoin, $8 or $9 worth of, probably going to produce $8 or $9 worth of Bitcoin, but your power cost is going to be a bit higher. And so now there's no margin to run those things. And so you have to be at, what we call grid scale. Which is where the pubcos are at today. So your Core Scientific, Argo, Riot, Clean Spark, Iris are all at massive scale.
And just explain again what grid scale means.
They're actually contributing to grid stability. So somebody like, let's use Riot as a good example. They're really the prototype for this type of miner. They're close to just under a gigawatt of total energy. A gigawatt is on a scale of like how much energy. That's a ton of energy. The Bitcoin network probably uses around 11 gigawatts right now.
So they're nearly 10%
of the total capacity. I don't know if they have that all plugged in,
right?
And if it's all mining Bitcoin, I don't know that specifically, but they're using that to do demand response. So in July of this year, power prices in ERCOT, which is the Texas grid, were through the roof. And it made way more sense for them to turn off their machines and sell back the power that they had been allocated through their power purchase agreement back to the grid. And so when they released their July mining report, it showed very little Bitcoin mined, but they had a caveat that we also made close to $11 million in reselling the energy that we had back to the grid. And so what that meant was the demand for energy was significantly higher than the supply for energy of energy on the grid. So they turned it off and allowed that supply to flow through.
Right. This ERCOT kind of case study that's been building in terms of grid stability with miners, is it happening anywhere else? Or is it just in Texas?
So they do. I mean, what it's called demand response or controllable load resourcing, and that is that's something that occurs on most grids. You get some incentive from the RTO to send that energy back into the grid rather than consuming it. And there are entire business models built around this. Factories.
But I mean specifically with miners.
Oh yeah, but miners, we think that miners use a ton of energy, but they don't actually use enough energy to really make a huge difference yet in grid stability. But they're getting there, right? They're building out tons and tons in Texas. Texas is around ERCOT's total generation capacity is around, last I checked, around 85 to 90 gigawatts, and they have it's called a demand delta of somewhere around 30 gigawatts. So we're actually getting to a portion of that under being controlled by mining machines, which you can you start to see a bit of stability introduced, but we need to add, another 0 to the number of miners in Texas. So going from, a couple of gigawatts worth of energy to 20. And if at that scale, you would start to see significant grid stability, demand curve delta compression. The demand curve delta is the delta between the amount of demand at the peak and the amount of demand at the low, at the trough, and whatever that difference is. We could start to see that really compress. The reason that's beneficial, reduces strain on the grid, makes it a more efficient grid because you're not turning on peaker plants and things like that during those high amplitude moments.
Do you want to explain what a peaker plant is? I'm not sure everyone will know.
Oh yeah, a peaker plant is a natural gas. It's usually a natural gas generator, and the reason they call it a peaker plant is because it really makes it only makes sense to turn on when the peak demand is high and people are willing to pay more for energy, and they turn on quickly. It's not as cheap to produce energy with them as some of the the more stable base load generators like coal and nuke, but it can be profitable, and that's why they exist. And they're the ones that come in during that high demand portion of the of the day. Usually, if you're in Texas, it's probably midday when it's hot in the summers. Everybody has air conditioner on. Businesses are running. People are home turning on dryers and all of that stuff. And then in the middle of the night is when there's lowest demand, and coincidentally, that's when a lot of the wind kicks on, is in the middle of the night. So that's a time when you'd want to be mining, and all the peaker plants would be turned off and that sort of thing.
Okay, so a lot of these miners are now in distress, and there's a couple of things that stand out to me. I guess one of the difficult decisions miners have is when to sell the Bitcoin they've mined. I know a number of miners, ones I've spoke to, said straight up, we're not selling Bitcoin. We're not selling any of the Bitcoin we've got. But they were using the Bitcoin for collateral or to take out loans to increase the size of their operations. So that was one thing that really stood out. But then also they were using the equipment as collateral to take out further loans. And it feels to me the one problem that seems to have hit the industry is I think everyone expected Bitcoin to peak at a much higher price. I don't think anyone I spoke to thought, if you said to them, this cycle, where do you think Bitcoin will peak? I don't think anyone would have said, around 60, 70,000. I think almost everybody expected we would hit over 100,000 of Bitcoin. I don't know why we didn't. You can come up with a number of reasons why we didn't, but we didn't. And it feels like perhaps what's become the problem for these miners is that they've, you never want to sell on the way down, right? So even when we hit 69 and we dropped, I think a lot of people felt it was going to come back. I mean, I did. Otherwise, I would have sold some Bitcoin. But now they've gone in a position where they don't know when to sell. And it feels like some have had to wait till almost the bottom to start selling off, and also to service their debts. And then even some of those now can't service their debts. Is there like a consistent issue, like a consistent set of problems that have hit these miners? Is it everything I've said? Is it something else? It's
certainly a confluence of events, things that you've mentioned. They're, even if they had that high debt load, if the margins had stayed high, they would have been able to service it. Even if Bitcoin price had gone down, maybe if difficulty had gone down with it, or we had seen more transaction fee volume, which would have increased hash price, miners would have been okay because the margins would have been high enough. So let's get into like the super basic economics of how some of these mining loans work. They're generally very aggressive amortization schedules, meaning you're financing over, say, 24 months. Imagine buying a car and if paying it off in 24 months, it's going to be a very high payment relative to the value of the loan. So if miners that have no debt are able to capture the bit of margin that they have, and then call that their free cash flow. Now, the miners that have debt, they take that operating income and then they have to service the debt. And that's really where we're seeing miners start to fold, is because of the extra amortization of the mining loans. So if I went and took out $100 million, or let's use even numbers. I took out $48 million. I have to pay $1 million a month. $2 million a month over the course, plus the interest on top of that. So if my operation makes, if I make $4 million and I have to pay $2 million,
happy days.
But then you have to pay the interest. Your free cash flow is now negative. So you're drawing from the balance sheet.
Hold on. If you were to pay $2 million plus interest, but you're making $4 million a month.
Well, you have to pay $2 million in energy prices.
Oh, okay.
And then you have to pay $2 million on your
debt.
mining loan.
Yeah.
And then you have whatever other operating expenses that you have, plus the interest. You have what's called negative free cash flow, which means your mining operation, you have to draw cash from somewhere else. Either that's from your balance sheet or other operations that allow you to make income, but no longer is your mining operation producing free cash flow. And that becomes a very big problem. So that starts to trigger what are called covenants in these mining loans. And that's why we've seen big miners selling off batches of their machines, is they trigger some covenant with their lender where they have to reduce the overall exposure, either reduce the collateral, so they sell off some loans, pay back the debt early, or they go into a restructuring where, say, you tack on potentially a year or something like that to the note to reduce that expense, that end of the month debt payment.
Do you think some of these companies have been reckless? Have they been unlucky?
I
know you probably don't want to throw people under the bus.
I wouldn't throw anybody under the bus. I don't think none of them seem to have been egregiously reckless in my mind. Around this time last year, everybody thought that buy more machines. That's how you get a higher valuation. That's the equation. And so they were just doing what the market told them to do, and then the market obviously changed direction pretty significantly. And let's look at one of the highest debt load companies is Core Scientific. They have some unsecured debt, they have secured debt, and then the secured debt is the most senior, meaning the debt that would get paid back in a bankruptcy scenario would be the debt on the machines themselves. And so right now, they have something like, I think it's like 836 million in total debt outstanding.
So would the secured debt be the machines and the unsecured be the energy?
There's unsecured, which is not secured by anything. There's secured convertible notes, which is secured by anything that isn't any unencumbered mining machines. So if they owned them outright, or infrastructure, or assets what other assets on the balance sheet, PPAs, collateral posted for those PPAs, that would all be included in the secured debt. That's held in that secured debt.
Is unsecured likely something you're just going to pay a higher rate on because it's unsecured?
Yes.
Okay.
Yeah, it's like if you went and took, imagine you went and took a $50,000 loan to buy Bitcoin with, and you didn't secure it with anything.
I see.
That would be an example of an unsecured loan. So that would be.
Well, it's a bit like if you go out and borrow against your Bitcoin, whatever your LTV is affects your rate.
But that's secured. That's secured, right?
But how much you're securing it affects the rate you pay.
Right. And these loans were generally between 20 to 50%. Generally, I would say the median would probably be around 30% LTV, meaning 30% of the value was you're holding about 30% of the value. So in the case of some of these loans, so for example, I wrote down here that that BlockFi lent CoreSci $52 million. That probably represents $150 million worth of, around $150 million worth of total mining equipment that was purchased at, unfortunately, the peak, around the peak.
$10,000 a machine.
$10,000 a machine, $100. So that probably represents somewhere around 15,000 machines. It works. The numbers are actually nice and round if you kind of work into it that way. Works out to about 15,000 machines. And unfortunately, those 15,000 machines are depressed maybe probably about 80% since the loan was issued. And so during that time, I don't know, of course, I was making, if they were doing covenants or making good on their covenants to BlockFi. Most likely they were, meaning they sold Bitcoin or sold something to pay down a portion of the loan early. But that's what's putting pressure on these miners. That's just a very specific example of what's happening more ubiquitously across the entire public mining market.
Just on that point, when you take out a loan with a BlockFi, Ledger, any of these companies, you over collateralize and then you hit a margin call price. Right. I wonder if there are margin call prices on market prices for the machines.
Yeah, they
do exist.
A lot of times, there are contracts that actually use Luxor's hash price rig index. We go out and source the machine pricing across different models from around 35 different data sources and try to produce a reference rate for the value of a machine on any given day. And we have heard and have seen contracts that use that reference rate as the mark to market. So as you see the value of machines decreasing, the mark to market, the LTVs start getting skewed, and miners have to top up to pay that. And that's when I said covenants, that's effectively getting margin called based on the value of the collateral going down.
Okay, just another thing. I've been taking a lot of notes here because you've just bringing up a few things that I want to ask about. You talked about the transaction volumes dropping, and therefore that affects the amount the miners earn for every block they find. What's the range that we've been seeing in terms of percentage of the revenue that's coming from block reward versus transaction?
1% or so of the total reward comes from transaction fees. 1 to 2%.
Oh, so
very,
it's still
very low.
Very low.
Contrast that with the bull run in late 2017 and 2018. We were seeing 150%, and that was also when
Hold on, you're saying the bottom is 1%.
What's that?
You're saying the bottom is 1%.
The bottom right now is about 1%. During 2018, we were seeing transaction fees being 150% of total block reward.
Was that when you would pay $50 to just get into a block?
That would more than that, but yeah, during that time you were paying massive fees. Right now you can fit around 2,000 transactions per block, and there was just a massive backlog, and people would.
Is there a chart for that?
Yeah. It's on hash rate index, so you can pull it up there. But yeah, so during that time, transaction fees as a percent of the block reward were insanely high. We also saw consistently that pre-mining ban, transaction fee volumes were much higher, double digits, teens, low teens. And post-mining ban, it's never been the same. And so this led a lot of people with tinfoil hats and conspiracy theorists to think like were the Chinese pools doing something, or like Chinese miners trying to inflate the amount of transaction fee in the block.
For what reason?
To increase their total mining rewards. So they knew that they had the majority of the network. They would mine the majority of the blocks. You could probably do some math to figure out if I make sure that the amount of transaction fee is above a certain amount, I'm going to start my expected value from doing that activity is X.
But isn't that cost neutral? Because if they're faking, they're actually having to spend the Bitcoin to put them in the transaction.
Well, they're spending the Bitcoin, but they're getting the Bitcoin back because they mine the blocks. And then the marginal transaction, so your and my transaction, or whoever's, they have to pay that higher fee, and then that gets captured.
So they're driving up our fees.
Yes.
Yeah.
Well, that was there you go. Yeah. That's
okay. So
that's average transaction fee.
And then as a percentage.
As a percentage.
And then here it is as a percentage. Yeah.
All right. Okay. So generally, it's about like.
Then you can see the mining band there at the bottom right, and we've just never really recovered.
So the mining ban is that like mid 2021?
Mid 2021, yeah.
Okay, so 2019 to 20 got up to about 10%. Then there's a massive amount of activity, but that is also bull run time.
Yeah, bull runs cause transaction fees to go up, cause hash price to go up, margins to go up. Everybody's making money. Everybody's figuring out how can I lever up, how can I pour money in, how can I get ahead of this, and then they just expected that to go maybe another 3 to 6 months. I think if we had seen hash price above 15 to 20 cents for another 3 to 6 months, a lot of these miners would be in a much better position. They would have been able to get a little bit further through their very aggressive amortization schedules. They would have had a more balance sheet to withstand that negative free cash flow that we're seeing now. And they would actually I think they'd be in a really good position to, weather the bear market. Because, a mega miner like that, they do produce positive cash flows. It's just when you add in the leverage, that's when things start to kind of break down.
Right. Okay. And do we know if the Lightning Network has reduced the number of transactions within that go into block reward? So, for example, we were selling our merch at the Pacific Bitcoin, as you know, and I would say, I think we did maybe around 100 Lightning Bitcoin transactions, of which 5 would have been base chain.
Okay.
We still did them because people didn't have any Bitcoin in their Lightning wallet, and the rest were Lightning. Now, the Lightning ones, if the channel's already open, there's no transaction fee going to the miners. But the base chain ones there are.
Right.
Do we know if the Lightning Network is having that impact, or is Lightning Network just new transactions that wouldn't have happened?
So it's hard to say. I don't know exactly if that is the theory. If you're not conspiracy theorist about the Chinese miners producing transaction fees that introduce kind of a base layer of fee reward, that would be the other, one of the other causes, or it's just lower interest in the network as a whole. I mean, if I would have gone, if I would have gone over and bought stuff from somebody that had a way to pay with Bitcoin, probably would have done a base chain transaction because it would have been what, 5 cents.
Yeah.
The Lightning right now is it's hard to really justify opening those channels just due to the economics being so in favor of using base chain currently.
What miners meant to be using futures to protect themselves against these situations?
Okay, well, thank you for the meatball. So,
yeah, well, so I don't fully understand futures, right? I mean,
Right.
I do. I know you can hedge. I know historically from watching, is it Trading Places, where they're the futures for the orange juice market, and the futures are there to protect if there's the crop isn't as as they expect.
Right.
If there's storms or they don't harvest as many oranges, the futures give the farmers a stable price to have a stable income for their land.
Right.
And my understanding was meant to be the same for Bitcoin miners, that the futures would exist for them to protect themselves for this kind of variability.
So there's really no future product that exists today for hedging your outputs. So there's output of a Bitcoin mine, which is Bitcoin and generally dollars. Bitcoin miners most generally should be trying to get to dollars to reduce the risk on their operation. And then on the inputs, that's just energy. And so there are some ways to hedge energy today. You could buy energy forwards. You can do different types of strategies. Maybe buy if you know that your energy source is nat gas, you can try to buy nat gas forwards to lock in some input, some of your input costs. But there isn't a great way to hedge your outputs today. There are some bespoke products called physically delivered hash rate forwards. And what that means is, say you have 100 petahash of hash rate, I buy it from you at, some value today, $55 a petahash today, and I'll buy it from you for a 20% discount. And then you lock in that value. So you then take, what's 20% of 55, what's that, $11?
20% of 55.
It's going to be $11 off. So I'll buy it from you for 44, and then you're locked in. So now you know what your input, you know where your outputs are going to be over the next 6 months. The problem with that type of contract today is that it requires heavy collateralization, meaning I have to collateralize as both the seller and the buyer. The buyer has to put up whatever the value of that contract is on that day. And then the seller also needs to put up that amount, because there's nothing stopping the seller from just unplugging their machines or pointing them to some other pool or whatever. There's no physical constraint on that.
Right.
You would have to get in, that would be like a default scenario. And then you'd have to, so they generally need to be collateralized pretty heavily. Luxor recently launched a new product called a hash price NDF. NDF stands for non-deliverable forward. What does that mean? It means that I don't actually, as a miner, have to deliver you the hash rate. We look at the reference rate for what the value of that hash rate was, and we settle the difference. You don't have to collateralize nearly as much, because we know the volatility over a certain period is we know what the bounds are on volatility, and we can also introduce margin requirements, maintenance, things like that. And you're not actually exchanging physical hash rate, which if you're having to exchange physical hash rate, that introduces a lot more complexities. The contract gets much longer because you have to have verbiage around uptime and availability and, like what are the default scenarios? And, if I'm below, my delivery schedule, can I top up? Can I go buy hash rate and make my contract whole? All of those things add complexity to a physically delivered contract. And so we really wanted to reduce that complexity by doing this NDF. So let's walk through like the mechanics of what an NDF is like. So you and I, we say in that same scenario, we'll do a 30-day tenor, 30-day contract. Today hash price $55. We've seen tenors trading. We've seen that 30-day tenor trade at about 2 to 3% discount to spot. So I'm gonna, if you're gonna buy my hash price, you offer me that discount, I sell it to you, and then over the course of the next 30 days, Luxor hash rate index produces the reference rate every day, and then we settle daily using a time weighted average over the course of the contract, and then we get to the end, say it's $60. I owe you then I owe you the time weighted average difference between 55 and 60. If it was linear, then I owe you $2.50 for that contract. So we can actually, we can take collateral for that and, about right now we say 30%. And when we take that collateral, the reason we're holding on to that is just to make sure that at the end, there's we can move the funds from the buyer to the seller, whichever side of the trade wins, and also that you're not going to default. And we know that over a 30-day tenor, there hasn't been a period where we've seen that much volatility ever since the inception of Bitcoin. So that's where 30% came from.
Right. Okay. Danny, can you bring up the hash rate chart? So we've spent the last 30 minutes-ish talking about the difficulties that all these mining companies are having.
Yep.
Hash rate is skyrocketed. Why?
So
because look at that. That's fucking unbelievable.
Well, that's all time. That's a hard one.
But you, I mean, Danny, you can go to the last year. It's the last year everyone's been in pain.
Yeah.
And especially everyone's really been in pain from the drop in about May.
Even in the last 3 months.
It's been the last 3 months. The last 3 months is really the pain period.
Yeah. Yeah.
Anything under, I would say, anything under about 12 or 13 cent hash price is really going to be where things start to get iffy.
But the hash rate's up nearly 50%. If you say the bottom's just 200, we're nearly at 300. Like it's up about 40%. How is hash rate up 40% when everyone's in pain?
Yeah. Okay. Great question. So as I was mentioning about what happened this time last year, there was massive investment happening, but that investment doesn't just show up. If I go buy 100,000 mining machines, they don't show up this month or even next month or the month after that. They probably are going to start showing up within 6 to 9 months. And so those machines were getting plugged in late Q3, mid Q3, late Q3, and now they're all starting to come online. And what I mean by those machines is, when we saw the pubcos going and investing and buying hundreds of thousands of mining machines, Marathon Digital famously bought, 100,000 mining machines this time last year, and they're now all starting to come online. So that hash rate that's coming online now is hash rate that was paid for a year ago and is now starting to show up, which is really going to crunch, the margins on that investment. And so it's going to be interesting to see how this plays out over the next, probably I would say 12 to 18 months.
Is there more to go, do you think?
I believe so. Yeah, I believe there's still more to go. And it's, I would say we're getting close to being somewhat saturated in the US market because our energy prices are a bit higher than you can find elsewhere. But I think there's still going to be mining done in other places. So, there is some concern that maybe nation states are starting to turn on machines and mine at whatever it costs just to get around sanctions, that sort of thing.
Concern?
Well, I shouldn't say concern, but there are some rumors or theories that may be where some of this hash rate is coming from. Say a Russia, they're sanctioned, they can't participate in the majority of the world's banking system currently for what they're doing over there, and they could be taking Bitcoin mining machines, plugging them into their effectively free natural gas generators, and they mine no matter what, or they mine regardless of what the economics look like, and that could be a scenario that is playing out, and we'll see. I think we're going to start to see over the next 6 to 12 months if that is the case. The reason I think it'll take that long is we're getting to the point of like the marginal machine right now is not nearly as profitable. I mean, your margins are single digits, maybe low teens on those machines. And if hash rate continues to grow, that margin's going to continue to come down. And if we reach a point where the marginal machine has a 0% margin and hash rate then continues to grow, we know that there's somebody out there that is mining at a loss, and they may not care because the value that they're getting out of that hash rate is greater than the economic reward at face value.
Then what happens to the public companies? Is it a race between who can survive the longest?
Yeah. If there's entities out there that are able to mine at effectively zero cost, there is no way for miners to really miners that have to pay for energy to compete.
So that might require Western nations to subsidize miners
if they
keep the hash rate.
If we want to keep hash rate in the US, that could potentially be a case.
That's what Jason Lowry talked about, didn't he?
I don't know. I've not heard that.
Mining as national security, I'm sure.
Oh,
we talked about that on the pod last time.
Yeah.
That mining, mining is a matter of national security. If we're gonna, if the U.S. government wants to protect, its Bitcoin, constituents, that would be something they need to do, is make sure that their Bitcoin holders within their country are protected from foreign influence and foreign intervention.
Per block mined, what is the difference in price that miners are earning between the current cycle and the previous cycle, pre-halving?
Yeah, so there's around pre-halving.
Yeah, pre-halving. So pre-halving now,
Yeah.
it was 6.25. We're now
Yeah, so it was 13.5.
6.5, wasn't it? And then 3.75.
It's 6.25.
6.25.
6.25 currently.
So it's 3.1. The next one will be 3.125.
Yes, exactly.
Yeah, so it's 12 and a half last time.
What do you think? What do you think the price was in April of 2020? I don't remember.
Oh, good question. Let's have a guess. April 2020.
See if you can get the
I want to
closest.
say around 18,000.
Oh,
No.
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 Had we gone up after that?
It would have been like 9,000. Right?
Yeah. I think it
Oh,
would've
that
been
was
lower.
pre-run.
Yeah.
When did the run start? Was it June?
It was late 20.
Was it late 20?
April 2020 was about 7-ish. 7 to 8.
Okay.
Something like that.
So a block of Bitcoin back then in April of 2020, pre-halving, 13.5 BTC.
12.5.
Was what's that?
12.
12.5. It was about 94,500.
Right.
Now block is 6.25 times spot price today. Is
16 and a half.
We'll say 17. It's 106,000. So it's
Okay.
actually a little bit more per block right now.
But a lot more
on
competition.
But there's significantly more competition, probably over double the amount of competition.
Where I'm going with this is we are a year and a half away from the next halving? Where are we?
Yeah, it's going to be in late April, early May of 24.
So if the price doesn't recover, that's going to add even more pressure onto the miners.
So we had that conversation, internally last time. What's going to happen post halving, and that was during that time, in the 2-ish months after halving, is when we saw the lowest hash price to date. I guess till now was in that summer of 2020. That was the max pain event for miners.
Hold on.
Today.
Sorry to interrupt. Does the hash price that you quote, is that the leveler between, so you can ignore the block reward and the halvings?
You can block reward, halvings,
Yeah.
difficulty, all of that stuff.
Right.
That number that Luxor
yeah.
produces, the Luxor hash price index, is the aggregation of all of those metrics
Yes.
into one reference rate that we use for the value of hash rate. That time it was around $70 a petahash per second. We're now at 55.
Okay.
And so that was at that time, the lowest margin environment that we'd ever seen. But now it's even lower because hash price is lower, energy prices are higher, your inputs are higher, your outputs are lower. The margin that you have to make in the middle as a miner is the lowest it's ever been.
Right. Okay. So how do you think this is going to play out over the next year? Are we going to see what's going to happen with Core Scientific? Are they just going to renegotiate? What's going to happen with all these other large public miners? I don't know the state of them all, but
yeah. So it's those that have the lower the debt load currently, the better the miner is positioned, because as I mentioned, they can mine profitably. They will produce free cash flow at the end of the month. If you plug in an S19 at Riot or Corsair, it's the amortization schedule of the debt that's going to be
the issue.
The killer. So anybody that has high debt is in a very precarious position and is probably going to need to renegotiate some of that load. The miners like Riot has a very low debt load, Clean Spark very low debt load, and so those types of miners they're also well positioned to accelerate through this because they are producing free cash flows, means they can reinvest, that sort of thing.
and some have diversified their income streams.
True. HUD 8 also
Yeah.
has diversified income. So they're trying to do like high performance compute and things like that, which make a ton of sense because really at the end of the day, most miners are really reminiscent of like an energy company. They or a traditional data center. And so as long as if they can monetize the input with some margin, they should be doing that. And if there's a higher margin activity they could be doing, like doing high performance compute or switching to a traditional data center, that's something that it makes a lot of sense for them as a business, especially as Bitcoin margins go down.
So back to your internal discussions about the halving.
Yeah.
Could we see bloodbath in the mining industry if we don't see price recovery?
So over if we don't see a bit of relief from specifically hash price, dollars per terahash or petahash over the next I would say over the next 2 to 3 months, that's when we're going to reach, it'll be max pain for anybody that has a mining loan. And these mining loans, another really interesting note is that most of the mining loans, they won't lend over, the lenders won't lend over the halving. So most of the notes, they won't lend over the halving because the economics, that is such like a big,
unknown.
Yeah, that's such a big economic event. It's impossible to know, is my mining loan going to be, like, am I ever going to get it paid back? So they won't lend over most of them will not lend over the halving. So that means we're kind of in this, we are unwinding, right? So leverage is unwinding. Every month that goes by that a miner doesn't, default, the amount of leverage in mining is going down because, they're paying down one more month of amortization. And so, as that progresses, we are slowly unwinding. But who's going to, is somebody going to capitulate before that? We'll see.
There'll be some interesting distressed deals, perhaps.
Yeah, there's some big batches of machines that are coming across our trading desk, and we're seeing pretty aggressive pricing on them.
So give me an idea of price.
15 a terahash.
What does that mean for a price of an ASIC? Like what can you get an S19 now?
$1,500.
Fuck, I paid 10,000 for each of mine.
So
is that? And do you think that's a good buy?
So you can look at it from an ROI perspective, and that's actually Bitmain will most likely. So this chart actually is. We try to normalize this across a lot of different models, and so it won't show like.
Just explain this chart to the people listening.
Yeah, the chart that we're looking at here is the ASIC index, and this is like I mentioned, we produce this reference rate daily for a tranche of machines based on their efficiency level. So the lowest there, the red line there is the. That's the most efficient machines, under 30 joules per terahash. Right now, like I said, the J Pro is, I think it's 32 joules per terahash. And so that's like the reference rate. I don't know. Can you click on there and see what it shows?
Can you go up a touch, Danny?
Yeah.
Go up to all. I just want to see. So they do go up as well.
Oh, yeah.
Because we were only seeing.
Absolutely.
I tell you what I'm thinking. These might make a good investment.
To buy and hold or buy?
To buy and hold the machines themselves. Because, I mean, if you look there from, October 21, what's that? That was like a 400% increase in the...
So the bottom line is actually, the top line, here is actually S9s. S9s in the last cycle, that was the Bitcoin beta play. S9s were effectively free. During the last, during summer of 2020, people were selling S9s for scrap, $20.
I had 70 of them.
We talked about.
I told you about
140 of them.
Yeah, well, I had the 70 were Dragonmints.
Yeah.
So even when I actually sold my S9s, nobody wanted the Dragonmints. The Dragonmints literally were $30 for scrap each.
And that was only if they came with the power supply, because I need that power supply for other machines because you can reuse the power supplies.
Yeah, but I'm trying to remember what I got. I want to say like $200 a machine or $250. But I'd been previously offered $30, and I just hadn't got around to saying to the guy, like, yeah, get rid of them.
Yeah.
And then somebody approached me and said, have you got any machines? I said, yeah, I've got 70 of them. So what I'm thinking is like at the end of the year, we're coming to the end of the year. I've got a profitable podcast. I've got some money in the bank. If I don't spend that money, I have to pay corporation tax of 19%. But if I buy these machines, then I don't have to pay corporation tax because that's capital investment. It's spending your profits. So would it make sense to say I don't know, say I had $150,000 profit.
Yep.
Should I go and buy 100 of these machines?
Yeah.
Because that could be next year. They could be a 4x.
They could be. That
could be worse.
Could be worse. Yeah. The like I said, so the S9 was the beta play. You could buy them for effectively $20 a piece, and then they went up to there were some of them selling for $800-900 at the top. So
yeah, maybe I got like $700 a.
In the pod, you said 6.
Was it 6? I can't remember.
But anyway, so looking at
so what's the play this time? What's the play machine?
So it's really hard to determine to claim that right now. So or make the claim about is it a good investment right now? And the reason being is that we don't really know. You don't really know where hash rate's going, and the unknowns of hosting right now are really probably the biggest concern. It's hard to find good hosting because they're really constrained. All the big miners have gobbled up the space, and so if you're looking for hosting options, you're generally looking at small, potentially unexperienced operators, and
What
the
if you
costs are
don't
pretty
want to
high.
host them?
I mean, there is margin to be made. I guess you could put them in your garage. I
Can you not hold them for me?
have a warehouse, yeah,
Yeah.
but we can hold them.
I'm
but
just
yeah.
wondering if that's a good investment. I don't know.
Traditional wisdom would say no.
Okay.
But that doesn't mean that if Bitcoin goes on a run, it's a high beta play. I mean, the value could be zero. And if hash rate continues ripping, hash price continues dropping, and a J Pro becomes unprofitable at 10 cents, the value of those is going to be evaporated.
Down to what?
They're $1,500 today. People would probably be trying to get rid of them for a couple $100.
Well, then it does.
Yeah, I mean, it would trade very similar to the way an S9 did, and that
You
would,
could buy 100 machines for $20,000.
and I mean that's what people were doing that in summer of 2020, and some folks were warehousing them, and so if a J Pro got down to $6 or $8 a terahash, you'd probably want to start thinking about it, because that would be $600 or $800. But it's really hard to say what's going to happen with hash price, what's going to happen with these XPs, and it doesn't, Bitmain, one good thing for miners to look forward to is that Bitmain did not release an exceptionally more efficient machine this year. They did last year, which was the XP, which increased efficiency by about 30%. And so that means if you had S19, if you had J Pros or 19 Pros or any of the S19 series, that you were going to be, now competing with a miner that was 30% more efficient. So that there obviously reduces your incentive to buy some of the later generations. But now we're seeing that, okay, they're only going to produce the XPs for the next year. And so I at least know where the floor of efficiency is. And if I can maybe, play games with that, or I can make an investment around that, that might make sense.
How much pressure does this put on the likes of Bitmain themselves as well? Because,
Yeah.
so
So Bitmain made a really big gamble, they made a really big push into what are called the hydros. And that is a machine that comes purpose built for liquid cooling. It's, if you've ever seen a gaming PC that has those,
Yep, seen it.
those hoses on them, they're like that. It's not immersion, where immersion you put the whole machine into some liquid. This one is actually just has the hoses go onto the chips and cool it that way. They made a really big push into those, and I was at WDMS a couple of days ago in Cancun, and that was the message. They want to sell XP, they want to sell hydros, they want to sell XP hydros, and they think that that's the way to go. They made a really big investment, and we'll see if it pays off. Like you said, it does put a ton of pressure, because there's not a lot of people buying new machines right now. There's no capital to invest in them. Given the events of last week, there is no new capital coming either. So if you don't have money to go buy machines, the person that produces those machines is definitely going to be feeling some pretty major pressure. They're doing a lot of creative things to get machines off the shelves. That looks like subsidizing miners. So if you have sub 4 cent power, they'll give you a 50%, basically a 50% LTV, but it's machines. They'll give you machines at 50% cost, and you have to mine with them for a certain amount of time to effectively pay that back. So they're doing a lot of creative things like that, and there's a lot of companies that are doing other similar creative things.
Should we buy some miners, Danny?
I'm not sure. Sounds like a sketchy play.
Yeah, sorry guys. You definitely cost averaging here may not be a terrible play. That's where a lot of folks are buying in smaller quantities. The quantities and volumes that we've seen, actually, so we started to see volumes tick up in our, we do a brokerage business where we help miners that need machines acquire them, and we saw volumes start to pick up, towards the end of Q3, in early Q4. Most of Q3 was effectively dead. There was nobody investing in new mining machines because the value of them was in a free fall. You can see from the chart there from April to end of July was just basically a vertical line down. But then we sort of reached a little bit of a plateau, and that was when volume started to pick up, and that was when people felt like they could reinvest, or start making investments again with a little bit more certainty.
Do you think the Intel machines are going to disrupt this at all?
No, not right now. They're just not efficient enough yet.
Okay.
But I do think that if Intel continues to invest in this market, they will reach parity with the Bitmain machines. And the reason, so Bitmain pretty much has a stranglehold over I shouldn't say stranglehold, that's rather negative. They're competing at a really high level. And the way that they're able to do that is because of their relationship with TSMC. They get allocations that other people can't. They're able to produce more chips and more machines that other people can't. So that's the reason they're able to continue to hold such a strong position in the market. WhatsMiner would be second place. They get a lot of, they're able to produce a lot of machines, just not as much as Bitmain. Intel, though, since they own their own production, they would be able to go out and compete with Bitmain head to head on a volume basis. They would be able to produce enough machines. The only thing that's holding them back now is they just need to get to that efficiency level that it makes sense.
I talked about this on the show the other day. Everything is kind of a derivative of the Bitcoin price. We can see it there, 100%. Right? It's exactly the same for our business, which is just a podcast, 6 people making content. But our downloads, you could have a line there for our downloads, and it would kind of track the Bitcoin price.
Okay. Well, there's a Bitcoin price on this, so you can overlay it.
Yeah, I mean, ours would quite similarly follow that. I said this on the podcast the other day, what I don't understand is why people are not preparing for worst case scenarios. We conserve capital. We produce a good show and we invest in the show. But when we're profitable, we put money by. We have to create a runway. We've got a runway that protects us for about a year. We always want to be a year ahead. So if the market crashes or there's not enough sponsors about, we know we can keep making our show. I don't have to lay people off. We're protected. Now, there's a lot of people involved here in mining who've been involved in Bitcoin longer than I am. They know this, and I don't understand why they have not prepared for these worst-case scenarios. Well,
they were. I think they were trying, but the problem is this just happened too quickly. And so they, like you said, this time last year, most profitable time to mine ever in Bitcoin. People were shoveling money in as quickly as they can. Less than 12 months later, it's the least profitable time to mine ever. It's very difficult to make massive strategic pivots in that amount of time.
Right. Okay. And how much do you think this? There's been multiple things that feel like it's been hit at multiple angles. The increase that you got an energy cycle, as you've mentioned previously, and then you've got a complete collapse we've essentially had 3 Mt. Gox in the last 6 months.
Yeah.
Which hasn't really helped. I wonder where the price would have been. I wonder if what 3 Hours Capital were doing, FTX and Alameda were doing, was actually depressing the price. I wonder if none of that had happened, whether the bull run would have gone on longer and we would have settled at a higher price. I just don't know, but I have a feeling we got fucked by frauds.
New capital is delayed significantly now as a result of everything that's happened over the last 6 months, even more specifically the last week. New capital coming into this industry was sitting on the sidelines, may never come into this industry as a result of what happened over the last week and even 6 months.
Could that be a good thing? Do you want my reasoning?
Yes.
It could reduce the volatility. In that massive amounts of capital comes in very competitive market where you can see insane returns in a very short amount of time, and then you see all these capitulations. Could it be that a more kind of like a proof of work, a harder proof of work to create businesses in this industry will create better, more stable companies?
CZ said potentially one of the largest exchange and hopefully liquid exchange said that cost of capital, we shouldn't be thinking about cost of capital. You need to maintain reserves. You need to be thinking about how can I keep a low leverage in this market because of the volatility. And I think that by adding in, like you said, all this new capital flowing in quickly, that becomes very attractive to lever that up. And that's when we get these big deleveraging events that we're seeing now.
It's the Ray Dalio cycle on crack.
Exactly. Yeah. And again, poor miners are really bumping into two cycles that are occurring independent of each other. They are dependent on both of those cycles, but they're coming together at the same time. Energy and Bitcoin cycle. If we could go back to that chart, I wanted to show one interesting thing. The hash rate, the rig index with Bitcoin price. The interesting part here. So if you could put the Bitcoin price there. So Bitcoin has actually been rather flat since early July, right? You can see relative, there's been some bits of volatility there. But the very interesting thing is the price of machines continuing to go down. That is a direct result of the ROIs. Yep, the ROIs on those machines. Oversupply, ROIs. Hash price continues to go down. Hash rate continues to go up. That's what's causing those machines to continue to go down. Now, we saw another big leg down here. We'll probably see a leg down in machine prices, but I think machine prices are getting back down to their reasonable levels. And I think that if you start doing some ROI calculations, we'll start to see a pretty reasonable price for machines here over the next 3 months or so.
Right. Okay. How has this all affected Luxor? As a customer, I'm interested to know.
Yeah, absolutely. So
just so people know, like I mine and I bought my machines through Compass.
Yep.
And I'm now a customer of yours.
Yep. So Luxor is a Bitcoin denominated company. So in that regard, it's obviously last year was significantly better.
Hold on, you run on a complete, you use Bitcoin as a unit of account for the business.
That is not, no, we don't run it out entirely on Bitcoin, but I denominate how Luxor is doing based on how much Bitcoin it produces in a month.
Okay.
So we produce more Bitcoin than we've ever produced in any month in both August and in September. So that from a Bitcoin denominated perspective is really good. Unfortunately, that Bitcoin is worth a third of the value it was this time last year. So from a dollar perspective, November of last year was the best month we've ever had. Probably almost every single crypto-based company was the same. All the exchanges had record months, record quarters. People were selling, tons and tons of machines. Everything was amazing. So a year later, we're certainly seeing that we're feeling the pain. Luxor's in a great spot relative to the rest of the market, but to say that things are amazing is certainly not. It certainly wouldn't be truthful. So we're sitting here waiting to see what is our next play. We haven't done any layoffs. Probably not going to have to do that in any significant amount over the next bit. But really, the big change in strategy for Luxor has been just around our hiring plan. We had a lot of folks that we wanted to get in to build the products that we're building. We're taking a pause on that just to see where does this market go, and that seems to be the best companies in the industry are really trying to do that right now. They're basically just sitting tight, preserve capital. Let's reduce expenses where we can, just maintain free cash flows, and see where this goes over the next couple of months here. Because if every month that you make it through with a green number at the end, that's a really good month, and that's really what we're trying to do here. So we produce net income, and all of that is great. So we don't really burn like traditional venture-backed tech startups. So in that regard, it's a lot less pressure than say, some like blockchain metaverse company that doesn't have a product and doesn't generate any revenue. They were banking on that VC money. Their runway has gone down significantly, and now they're scrambling because there's no new capital coming into the space.
Right. Have you not taken any investment?
So we took our Series A from NYDIG, and that was it. Actually, we have a new strategic partner. Hive Mind Capital has come in, working with Jake Greenstein, Scarlett, and Matt Zhang, and they're getting into the mining space here. And so they came on late. We put together something so they could be a part of the Luxor story, and really excited to get them on. Press release isn't out yet, so breaking news. But just them. But we haven't raised any significant amount of capital since the Series A that NYDIG led in late 2020.
Are you? Most companies, once they've raised a C round, Series A, they're always thinking about the Series B.
Yeah.
Are you essentially just trying to build a company without raising capital as much as possible?
So that
great.
is 100%. So the story of Luxor, we were bootstrapped. We were Eddie and I founded the company in 2017, actually August of 2017. And during that time, we just built this as a hobby, nights and weekends. I was working at Salesforce. He was working at Nebulous Labs. Actually, I think he might have even still been in school for a little bit. And so we're just working on Luxor nights and weekends. And then over the course of the next year and a half, we started, releasing some products and, started seeing people actually really like using Luxor products. So, we started generating a little bit of revenue, and we got to the point where we had enough of a bankroll that I felt comfortable leaving my like cushy
Nice.
Silicon Valley tech job to go become the CEO of a company of 4 in July of 2019. So that's when I went full time.
How many people are you now?
47.
Wow. Damn. Congratulations.
Yeah, appreciate that. Yeah, so over the end of 2019, the rest of the founders came full time, and then in 2020 we were going to go raise. We were going to do that jazzy pre-seed round, $1 million on 12 million or whatever it was, and then we bumped into COVID, and we're like, okay, we've got to sit. We're not going to raise in this market. We're not going to be able to. We got to figure out how to build products that continue to generate enough revenue for us to stay profitable. So we launched Luxor Switch, which is really, I credit Luxor Switch to keeping Luxor alive through 2020. Late 2020 really started getting a lot of traction on all of the products, as of course the market was really starting to go in our favor. Raised a Series A round from NYDIG, and ever since have not raised any capital. Reason being is we do generate net income, which is an incredible feat, and I congratulate the Luxor team for being able to do so. We were thinking should we put together, a Series B in late Q1, had some preliminary discussions, and ultimately decided that probably doesn't make sense just given valuations are getting crushed, and decided, okay, we'll hold off on that. And we'll maybe push it to Q4 of this year. And then of course, now we're probably not going to go raise. I don't think even if we wanted to, there's no new capital coming into crypto right now. So,
well, listen, bear markets are for surviving. And if you're making more Bitcoin at the end of the month than you've ever made, your trajectory is great for coming out of these kind of depressed prices.
Yeah.
So
we got to sit. Yeah, we got to really tightening the belt, making sure that we have really tight expense controls, things like that. That's really the one thing. We're really thinking a lot about what is the bottom line. How do we reduce expenses month over month? Is there a way for us to cut cloud spend or marketing or anything that. Anything that we can do,
What?
anything that
Fucking
we can
heresy.
anything that we can do to make sure that the line, that the number is green at the end of the month is really where we're at right now. So,
I mean, marketing is the one area I'd always say people should definitely not
continue
cut.
to double down.
Yeah, double down, especially if it's based on British football, because, no. Listen, by the way, I appreciate you doing that, supporting the club. What we've done with that football club, we couldn't have done without you and the other sponsors.
It's insane what you guys have done.
Dude, it's unbelievable, and we're having the time of our lives. But it's making a real difference to people's lives. We've got more people playing football because of it. My little town has got this like seed of a project that people are getting excited about. For the first time ever, the local ladies team is being paid. They've never been paid, and they're getting paid expenses, and they have to travel more than the men. So just out of interest, the men's team, everything's geographic, right? So we're in South Midlands League. The most the men's team ever has to travel is an hour and 20 minutes to a game. There's less ladies teams, and their division only has 12, and I go to as many of theirs as I can, and they have to go up to 2 hours 10, 2 hours 15 to a game sometimes, and they have to cover the cost of the petrol to get there, and so they've never been paid, and based on the fact that we've got sponsors like you, they now have all new equipment, new shirts, new tracksuits, and they get expenses to cover their costs. We couldn't have done that without you or other people, and that's making a real difference. This isn't just a vanity project. It's a genuinely interesting project that is changing the lives for some people. So I will always be grateful for you for doing that.
Yeah, I appreciate it, man. It's been really exciting to see. So tell me, how does the promotion work?
Okay, so
Tell me how that works.
So the goal is, I say the goal is Premier League. Realistically, the goal is the Football League. So you've got the Premier League, Championship, League One, League Two. They're called the professional leagues. That's the...
Okay.
It's a weird thing. They're called the professional leagues, but really, I mean, if you're in the one below, which is the National League, that's still professional. But it's a hierarchy, and you can be promoted and relegated between them. But the first division under League Two, the National League, that's known as Step 1. So they refer to the divisions underneath as steps. That's the one Wrexham are in. Ryan Reynolds, he bought Wrexham. That's there. They're in there. We're in Step 6. So we're 6 promotions from the professional leagues, right? Okay. But what happens is below the National League, it starts to split. So National League, then you go to National League North and South, 2 separate divisions. So they only have to travel half a country. And then Step 3, it splits again all the way down to where we are. The team who comes to the top of our division goes up. Here we go. We've got the table up. So the team at the top goes up, and the next 4 go into a playoff. Semi-finals, final, and so whoever wins that also. So only 2 can go up. The thing is, you really want to avoid the playoffs, because if you get in the playoffs and you just have one bad game, like we've lost one game, we should have won it, but we didn't. And so if we go into the playoffs, you're at risk of this whole season. You have one bad game, you go out, and that would be devastating. So our goal is we must win this league. We have to win it. So we just go one game at a time, doing everything we can. We are now top. We've played 15. We've only lost 1. We got 42 points. You can see we're 12 points above Northampton Silby, but they've got 2 games in hand. That means they've played 2 games less.
Okay.
So if they win their 2 games, they'll be up to 6 points behind us, right?
Okay.
But that means we've got a buffer of 2 defeats.
Okay.
We can afford 2 more defeats and still be above them because of our goal difference. So what happens is it comes down to how many points. If you're on the same points, it then goes down to goal difference.
Got it.
You know what goal difference is, right?
Yeah.
So you would essentially say
That 9-point game helped there.
what's that?
The 9-0.
Yeah.
Did you say 9-point game?
Yeah.
We don't call them points. We call them goals.
9 goal.
Yeah, 9 goal. Yeah. So it's going well. The great thing this weekend is we didn't have a game. Our game was postponed. So all our rivals had games, and it was a chance for them to catch points up. Northampton Silby lost to Eton Soken, and then Northampton Chenocks, they drew with Moulton. So we play next Saturday against Eton Soken. Be a tough game, but it's home, we should win. Then we've got London Tigers down near the bottom, we should win. Then we've got Tame Reserves, even lower, we should beat them. Then we've got Wellingborough Whitworth, we should beat them. So if we get through all those 4, we'll be halfway through the season and only have lost 1 game. It will be looking good. Then we've got last game of this year is Ampthill Town. Now, they are our rivals. They will outperform based on that. If we can win that, we then go into January, we play Langford. So my hope is we get to the past the first game in January, and we've played 21 games and we've only lost 1. We've then got 2 really tough games. We've got Silby away and Northampton Chinooks away. They're going to be 2 tough games. Now, if we get through those with a couple of wins, you start to think, okay, this is close. But it's one game at a time. Like my team is absolute warriors. Every game they go into fight, and they know just one more win.
One more time. The top team does not go to the playoffs. Then
the top team goes straight up.
Straight up.
Yep.
Got it. Okay.
The second team, second, third, fourth, and fifth,
Got it.
go into playoffs.
A 4-team playoff.
So the way it works with my manager, this is really interesting. Difference between the manager and the chairman. He is only ever thinking about the next game.
Okay.
All he's thinking about is Eton Soken.
Okay.
What are we going to do? How are we going to win that game? That's all he's focusing on. All I'm thinking on is next season.
Okay.
Because I've done everything I can. I've given him the resources to players. I've got to say, when we finish the end of the season, if we're promoted, I want to sit down with him on Monday and go, everything's ready for next season. Because we're going to have to get, maybe 3 or 4 new signings. We're going to have to spend more money. We've got to upgrade the ground. I need to be prepared and go, it's ready for you. Because I want to get from here into the League 2 in 10 years, 6 promotions in 10 years. I don't think it's ever been done. I want to do it, okay? That means I have to be ready every year. We're allowed 4 slip-ups in 10 years. I mean, I'd love to do it in 6 years.
Yeah.
I think we can do back-to-back promotions. I think we can do 3. I think we can go 6, 5, 4, 3 in 3 years. That's the goal. But it only happens with people like you.
Yeah, you need another. If you got another bull run, no problem.
Oh yeah, another bull run is like I'm going to raise for 4 years.
Listening to you talk about this was probably me going through like the math of like hash price. I'm like blown away. My wig is completely back, and I'm trying to like follow all of it.
Dude, I had no idea what the fuck you were talking about.
I know your eyes were completely glazed over, and you're like, "What are you talking about?"
I was thinking about on Saturday we're playing Eton Soken. I'm going to be in Vegas. We're going to find. Yeah, no, it's incredible. I tell you, there's some other incredible things off the back of this.
Okay.
So, the amount of merchandise that we're selling. Like, we sold $6,000 of merchandise at the Pacific Bitcoin Conference.
That's amazing.
Yeah, and all the merchandise we sell, that essentially will fund our ladies' team.
Yeah.
That's incredible. There's people wandering around Some guy said to me, he said, I was in the airport in Austin, there's somebody in a t-shirt that says Bedford. And it's hilarious. Like, my little town is getting marketed around the world.
Yeah.
Our meetups, we have meetups once a month before a game. A previous one, we had nearly 70 there, Emma. We had 70 people there coming to learn about Bitcoin. It's fucking amazing.
That's amazing.
It's the
I
whole
love it.
thing. I just got to keep it going, man. Come on, Bitcoin.
I love it. I love
Right.
it.
Anything we didn't cover you want to cover?
No, I got it all on here. Everything I talked about was good. I owe you 100,000 sats.
What?
I owe you 100,000 sats.
Do you?
We had two bets. One of them was, what is the price of Bitcoin going to be at the end of our last podcast? We said, I think it was 61,000, and I said, I'll take over. You took under, and it was a little under.
Okay.
Hertz also. And then we also talked about hash price. I said, is it going to go over 50 cents? And it never did. So,
So I bet on hash price, even though I
yeah.
don't know what the fuck it is.
yeah.
Jesus.
Yes. I mean, that's degeneracy at its max.
So
But,
what was it? 50,000 sats on each.
50,000 sats each.
What's
I owe you-
100,000 sats? What's that?
It's like $20. Right?
Yeah, $20.
$20.
Yeah.
I tell you what, you pay it, take a t-shirt.
Okay.
We'll sell
All
you a
right,
t-shirt for
gotcha.
that. You can take that back.
Absolutely. That's really all I got here, man. This has been amazing.
What's
I
your
really
bet, what's your
appreciate
bet
it.
for the next show?
What's that?
What's your bet for the next show?
Trying to think of something interesting.
Football, bring up the thing.
All right.
I'm going to give you a really crappy bet. I've got an idea. So we've got 38 league games, right? We've played 15. We've won 14. We had one defeat. So that's four.
Can we bet on goals?
Oh, that's quite a good get
I've
back
got-
'cause it's more random.
I think we could do points. So what does that aggregate out at points for the season?
Is it 110?
Yeah, to
isn't it?
divide 42 by 15. I'm not good enough to. Well, actually, it's
106.
106.
Yeah, 106 points.
Right, 100 points under or over.
100 points is, just to give you some background, is like unheard of. It's very, very hard
What's
to
the
get
maximum
100
I
points?
feel like I'm getting taken here.
No. What's the maximum points?
There's a chance I'm getting taken.
In the let me see. I think it's 110.
38 times 3.
114. Sorry.
114 is the maximum points we can get. And I'm saying over 100.
Okay.
Under over 100.
You're taking over.
Just
Well-
for context, the maximum points in the Premier League ever is 9. Is it 95?
Yes.
Wait, let's do 95. I'll take.
No, 100. No, well, I was going to say to you, under over 100.
Let's do the over. If you give me 95, I'll take over. And my normal sports betting bet amount is 250k sats.
Right.
Sorry, that's not true. Man City got 100 points in.
I want to take over 100 points.
You want to take over?
I want to take over 100 points.
Okay, so you're moving the line. So I'll take under 100 points.
Yeah.
250k.
250k sats. And you sponsor us next season.
We'll get to that.
All right. 100. Yeah. Okay. Let's get the man a t-shirt. Look, tell people where to go.
Yep. Check us out. Luxor.tech,
right.
hashrateindex.com. I'm Nick at #Bender on both Telegram and Twitter. Luxor Tech Team on Twitter. HashrateIndex on Twitter. If you want to email me, Nick at Luxor.tech. That's really it. Tell me how bad my predictions are. Well, whatever. But
All right, well-
love to chat about it.
Hopefully next time we do this, we've got a more positive Bitcoin environment.
We're not
to
talking
talk
about who's going bankrupt next, and
Yeah.
how's your company doing, and how's everybody. You know, who's going to go out next. I don't know.
Hopefully we'll be talking about another promotion. That's
what I want to talk
All right,
about.
man. Thank you, Nick. Take care, buddy.
Take care.